So guys, and welcome to another one of these videos. I know my voice may irritate some of you, so I'm gonna make this as quick and painless as possible. So I see a lot of things going around and I see a lot of confusion in the market. And one way to reduce that confusion is to have a set number of time frames you look at. It is okay to do top-down analysis, but for your executions and in planning those executions, I think it's best that you have only 3 time frames to look at. So what I mean by that is you have a long-term time frame, a medium-term, and a short-term time frame that you look at. Your long-term time frame is the trend that you are essentially following, and you follow the phases in the trend to execute, right? So when you are in a pullback phase in a 4-hour trend, then you're looking for intraday shorts or scalping shorts if you like. And when you're in a continuation phase in that 4-hour time frame, then you're looking for buys only. As good as a sell setup would look in a continuation phase, you just don't sell. And another thing is to have a 50-minute time frame where you will take the range of that phase, whatever phase you are looking at within the 4-hour trend, and then you'll zoom that in your 15-minute time frame, and on there you will look again to see when the tide changes, right? So it's important to understand on the 50-minute time frame and accept that the medium time frame hasn't lined up with your overall time frame. So let's say, for instance, if your 15-minute time frame is still bearish and you're looking to go long, chances are you'll get stopped out because you are trading against that particular trend. So it's important to wait for that time frame to line up with your 4-hour trend, right? So if you're looking to buy the continuation, just wait for that to line up. And your 5-minute time frame is your short-term outlook in your execution time frame. This time frame is usually the first one to show a shift in the sentiment. So if you were trending down, we'll usually see that there's a boss or break of structure on the 5-minute time frame before continuation of that 4-hour trend and the 15-minute trend as well, right? So it's very important to have these three things down, and it makes it easier for you. Excuse me. Another thing I really need to clarify is excuse me, the difference between a false breakout and a break and retest, right? If you look at the traditional support and resistance strategies, right? This is support and this is resistance. Whenever you see a candlestick close above and the next candlestick immediately trade back into or above that low there, and then in traditional support and resistance, that is a fake breakout. Support hasn't been broken, and the same thing applies when resistance is broken. When you see a candlestick breakout but immediately retrace below that high there, which is resistance, that is then considered a fake breakout as well. And when you see a support being pierced in terms like this, let me just get the right color here. When you see support being pierced like this with a wick, that then is considered a false breakout as well. So why do you then consider when you're trading market structure, when you see a high being wicked above and then immediately a retracement back in there, why do you consider it a break of structure? It's not a break of structure. It is merely a liquidity rate because there is liquidity sitting there, right? The same thing would be true if this low gets wicked out and price trades back up again. There's liquidity sitting there, so that liquidity was taken out. That's the only reason why price is doing what it does. So yeah, I have this illustration for you. This is not a break of structure. When you see one candle below a strong low, when you see one candle close below a strong low and the next candle immediately push up, that is not considered a break of structure. It is merely a liquidity rate below the structure low, and it's meant to fake traders into selling the market short when the market is indeed buying. So those are the two things that I want you guys to get right. And then order flow is another thing, which is a discussion for another day. If you have those things down to the T, your trading will improve by a month.